Hey everyone, Coach Investor back on our earnings report. I just uploaded the Intel report. If you missed that, it's going to be in the top right corner. Pretty surprising result, and the same can be said for Roku. They smashed it, beat earnings per share and revenue estimates by quite a lot. Still unprofitable, but results are getting better and better. And so let's go and have a look at that report. First, a little comment here from the CEO. By the way, this is the first quarter with the new CFO, and so guidance might be a bit conservative because he wants to play it safe. They beat their own guidance by a lot as well this quarter, so good start from the new CFO. So they delivered solid results in Q2, growing scale, engagement, and monetization. The operating environment remains largely unchanged from Q1, with strong consumer demand for Roku TV models, while TV advertising remains muted industry-wide. We have begun to see some ad verticals improve, which resulted in modest year-over-year platform revenue growth in Q2. And we are well positioned to re-accelerate growth as the ad market recovers. We continue to moderate the year-over-year growth of operating expenses and remain committed to our plan to deliver positive adjusted EBITDA for the full year 2024. Now, this is where things get a bit more interesting. So, total net revenue was $847 million. By the way, underneath it, you will see their own guidance, so you can compare that. So that was up 11% year over year. Platform revenue was up also 11% year over year to $744 million. Gross profit $378 million, up 7%, better than what they expected, or maybe they were sandbagging, who knows. Active accounts were 73.5 million, a net increase of 1.9 million active accounts from Q1. And as you can see right here, it is a little reacceleration in growth there. And so if you look at platform revenue, which has grown 11%, and then you look at active accounts, that has grown 16% year over year. So quarter over quarter, the difference here is that active accounts grew faster than platform revenue. And so the result is, well, monetization-wise, ARPU in this case is down. Now, streaming hours were 25.1 billion, up 4.4 billion hours year over year, flat quarter over quarter. And then for the first time, the Roku channel was 1.1% of total US viewing in May. More on those numbers later in this video. But to me, I've said this for a while now, to me, it's very important that we see active accounts continuing to grow, because monetization of those accounts will be made once the ad market picks up again. So in the meantime, you accumulate more and more accounts that will be better monetized in the future, and that's exactly what's happening right here. So right now, ARPU, while I'm still looking at this number, I'm looking at active accounts and the growth there much closer. Then when we look at the difference, platform revenue, device revenue, and then the gross profit from that. So as we said, platform revenue up 11%, devices revenue up 9%, but gross profit for platform increased just 6%. It's up quarter over quarter. Devices one, still, it will take a while until that becomes really profitable, if that ever happens. Still down 8% year over year. And so total gross profit increased 7% year over year, but there's still a long way to go there. Now, when you look at the margins here, platform is 53.2%. That's down 270 percentage points year over year. Devices did do a bit better year over year, up 300 percentage points there. But overall, total gross margin, 44.7%, which is still lower than what we were used to. Now, the issue continues here, which is an issue that was already here for a couple of quarters. If you look at total operating expenses, that increased 8%, while total gross profit only increased 7%. And sales and marketing, 23% increase year over year. I mean, we've been talking about this for a while, that expenses need to get under control, especially when profitability of the business is not really there quite yet. I mean, fine, there is research and development that decreased 2% year over year. G&A is only up 1%, but sales and marketing, 23% growth there. To me, it's a bit much, but hey, I'm just nitpicking here because overall it is a good report. Then when we look at income from operation, in this case still a loss, 126 million, better than expected. Adjusted EBITDA, 17.8 million, much better than what they were expecting. Then adjusted EBITDA margin, negative 2.1%. As for the outlook, they expect total net revenue $815 million, total gross profit $344 million, net income a loss of $155 million, so worse than this quarter, and the same thing here, adjusted EBITDA loss $50 million, which is worse than this quarter. In my opinion, they are just putting the bar pretty low to be able to beat it, and the investors will be happy. Now, for those that are still interested in this, Roku is still the number 4 position in ARK's ETF, in the combined ARK's ETF, by the way. Number 1 still Tesla, 2 Coinbase, 3 UiPath, and 5 Square or Block. And so let's continue here. So market leading scale. In Q2, the Roku operating system was once again the number 1 selling TV OS in the United States. And year to date, their TV unit share was larger than the next 3 largest TV operating system combined, according to Circana. We continue to achieve year-over-year share gains across the full range of TV screen sizes, particularly in the larger screen segment, which increased more than 70% year-over-year. This is very, very promising. And in Mexico, the Roku OS was the number 1 selling smart TV OS for the 3rd quarter in a row. As for driving engagement, they say here they grew engagement while viewing hours on traditional TV continue to decline. Global streaming hours on the Roku platform grew 21% year over year, while viewing hours on traditional TVs in the United States fell 13%, according to Nielsen. So far so good, right? After a horrendous 2022, 2023 for Roku and for other players in the ad market industry, it is a bit better, and we are seeing this in the numbers as well. I mean, the fear was maybe extremely high, and so when seeing those reports and those numbers, we're like, I guess things are getting much better than expected. Yeah, and you're gonna see a bit more later on, especially with regards to the Roku channel, monetization, shoppable ads, etc., etc. Now, if you're enjoying this type of videos, leave it a thumbs up. Subscribe if you have not. We're trying to reach 30,000 subscribers by the end of the year. So hit that subscribe button. It's free. So why not? Thank you very much. So the Roku channel, they say here in Q2, streaming hours on the Roku channel grew more than 50% year over year. For the first time, Nielsen reported that the Roku channel was 1.1% of total US TV viewing in May, which represents 3% of streaming hours, in line with Peacock and close to HBO Max. Pretty impressive. As for monetization, in Q2, platform revenue exceeded their expectations, but the macro environment continued to create uncertainty, with the total US advertising market flat year over year in Q2. Ad spend on traditional TV declined 9.4% year over year, and traditional TV ad scatter was down 17.2% year over year. Now here they talk a bit about their event called NewFront, and this, by the way, this is a screensaver that they're starting to work on with brands such as, in this case, McDonald's. They're working with Mattel as well, which is something nice, right? Having a screensaver, a branded screensaver, could attract some customers in the future. Then they talk more about the shoppable ad technology here, which they launched with Walmart last year. We've talked about the partnership with Shopify early on this channel as well. And then they say here, we are ramping up our work with third-party DSPs, demand-side platform, to capture incremental demand while being careful not to cannibalize existing revenue streams. Our first-party and automatic content recognition data, along with Roku specialized ad products, are accessible only on the Roku advertising platform, allowing us to increase demand and maintain platform distinction. Initial results, while off a small base, have been encouraging at capturing additional budgets. We expect it will take time to scale. We remain focused on diversifying our revenue streams and building an array of strategic third-party relationships that we will grow over time. I think this was something that an analyst asked last quarter or 2 quarters ago, and then a lot of investors have been commenting on this as well, and I'm very happy to see that they are going into this direction. Now, last thing here with regards to outlook, trends that we observed in Q1 played out in Q2, and we expect them to continue throughout the year. While consumer spend is showing some modest growth, macro concerns and uncertainty remain. Again, putting the bar low, not putting extra risk, extra pressure on their own guidance. So these comments were expected. And so if we look at the graph here, we're back at the prices we were not so long ago, $74.27, back over the 200-day moving average. Of course, during the earnings call, things can get mentioned. Stock could go higher, stock could go lower. Crucial points will be mentioned in this week's Substack. Link is down in the description below. It's free to enter. But overall, I mean, the stock has been performing quite well this year. I think it's up over 65% or so this year alone. RSI still neutral, MACD still bullish. So after this report, the reaction is pretty good as well. Market is happy, investors should be happy as well. Much better than what we expected. So that will be it for this video. Of course, do share your thoughts down in the comments below. Are you still holding? Did you sell? Let me know down in the comments below. If you enjoy this type of videos, leave it a thumbs up, subscribe if you're not. I'll see you all in the next one. Bye bye.